Okay, so we're going to start on chapter 1 today. Remember, we've kind of reviewed chapter 3, and we're spending one day on chapter 1, one day on chapter 2. Now, there's some homework in chapter 1, and that's due on September 3rd. So that's after Labor Day. That's the Wednesday after Labor Day. That homework is, it says chapter 1 homework, but it mostly has to do with the kind of stuff that we did Monday, assets and liabilities, that kind of thing. And then one part of it is just looking on the website. There's 2 different websites that you have to look at and answer some questions, okay? But it's not super hard, but there's 2 tabs on that homework. And a lot of the homework has 2 tabs. Do you know what I mean by tabs? It's Excel, it's on Georgia View. It's in chapter 1. There's like in Georgia View, it's organized and there's a chapter 1 section. In the chapter 1 section, the homework is there. Also, the PowerPoints are there. So this PowerPoint is there. You might think about printing out the PowerPoints so that you can take notes on the PowerPoints. In a lot of the chapters, I go over the PowerPoints in almost every chapter except for chapter 3. I don't really do the PowerPoints in chapter 3. And then there's also solutions to exercises at the back of the chapter. So I think I put the solutions for the brief exercises, but maybe not the exercises at the back of the chapter. And that's so that you can go in and look at similar problems or problems that you might want to review for test and such. And you'll have solutions there that you can work on your own. Because, you know, we can't go over every problem in the back of the book, but this will give you a chance to have the solutions for some of the others. Okay, so today we're going to do chapter 1, and that's just kind of an introduction to financial accounting. So let's talk about financial accounting. Financial accounting is like Principles 1. Okay, so this class, Intermediate 1, is kind of similar to what Principles 1 was. That's financial accounting, dealing with financial statements. What's the other kind of main kind of accounting, like Principles 2? Managerial accounting. And what is managerial accounting about? Helping managers make decisions within their own company. So helping the managers of the company to make decisions. Are we worried so much about the managers of the company in this class? We're really worried about, you know, the rest of the world, outside users of the financial statements. So creating the financial statements and using the financial statements and kind of the information that should be on the financial statements. That's what we're looking at, financial accounting. Okay, so as far as the financial statements, what type of thing, what are we concerned about? Well, first, accounting, the type of accounting that we're worried about is identifying and measuring the financial information, okay? So we want to know what kind of financial information is going to be on the financial statements and how are we going to measure it? Well, you might think this seems obvious how we're going to measure it. Do you? Because, I mean, there's several different ways to measure things. If you pay for something in cash, then it's just obvious what the measurement is going to be. But what's another way of measuring something? We use cash to measure things primarily. But are there other things on the financial statements that are not measured, like by how much we paid for it? Are there any estimates on the financial statements? Non-tangible assets, okay. Or what about accounts receivable? The accounts receivable, that's a cash amount, but then when we look at the allowance, that's an estimate, right? The allowance for doubtful accounts, that's an estimate. And then now now we're starting to measure more things with using fair value rather than historical cost. So investments are measured using fair value. So there's different ways to measure things, okay? So what things should we measure? How should we measure them? And how should we communicate that to the users? Okay, so we want to communicate financial information about economic entities. Let's focus on the economic entities a minute. What does that mean? The economic entity we might be worried about might be a company, or it might be a group of companies. So we need to be able to separate economic entities into units that we can measure. And we need to be able to distinguish this economic entity from the other ones out there, and separate that entity from the owners or the owner. So we need to be clear about what entity we're reporting on, and we're reporting to interested parties. So there's several different parties that are going to use the financial statements. So we want to realize who the users of the financial statements are or might be, and we want to make sure that the information is useful to them, okay? Okay, so this just kind of summarized what we were talking about before. The financial statements that we're talking about, we've talked already about what are the four main financial statements, right? Have y'all got those memorized? Should we go through them again? Balance sheet, income statement, statement of retained earnings, statement of cash flows. Okay, so those are the four main financial statements. Well, that's really cool. They've got them listed there, but then they've added something else. Do you see that? In the included in that list of financial statements is what? Note disclosures. Now, what do they mean by that? As something about outstanding loans, additional information. Okay, these are things that amplify the financial statements, and for the most part, the note disclosures are required. Okay, so I passed out a set of financial statements. So what I thought we would do, and this is part of your Chapter 1 homework too, is to get an actual set of financial statements, which you can get online. Any public company has their annual report online, and if you Google the name of the public company, like if you say Target 2013 annual report, it'll just pop up. Okay, so this company is a bank in Albany, and the CFO came and spoke to a group of students here about 3 or 4 years ago about accounting, okay? And he left me some financial statements to look at. So y'all share, if they're not enough to go around, find somebody and look through here. Find me where what we're going to look for here is the financial statements. Where are they in here? And where are the note disclosures? The note disclosures are numbered, and they start out and they say notes to financial statements. Anybody? What page? 35? Okay, so notes to financial statements start on page 35. Okay, see what note 1 is almost always the same thing in every set of financial statements. Okay, what does note 1 say? Summary of significant accounting policies. And look down there, it tells you something about the business and about various other things and how this company measures things. So look, for instance, at premises and equipment on page 37. premises and equipment, it says land is carried at cost. Premises and equipment are carried at cost, less accumulated depreciation, computed on the straight line method over the useful lives, and it's 39 years for buildings and 3 to 7 years for furniture and equipment. This is going to be the same note on every company, except sometimes this company uses the straight line method. A lot of companies don't use the straight line method. But here it tells you what method they use to compute depreciation. See, this is useful information for the users of the financial statements to know whether it's an accelerated or a straight line method and what the useful lives are. This would help the users compare these financial statements with somebody else's financial statements. So do you see what the notes are used for? Kind of background details, because the users of the statements are going to be like poring over these things and calculating ratios and trying to come up with an analysis to see what do they want to know? Who are the users? Maybe people that might want to buy the stock. So they're trying to make decisions about what to do. Okay, so that's note number 1. And then let's see, there's several different notes. I'm down to note number 13 now, but it goes on and on. See how detailed these notes are? There's 25 pages of notes or 26 pages of notes. That's a lot of stuff. Now, where are the actual financial statements? What page? You got it right there. What page? 60? 60. No, that is still a note. Note 19. 14 or 15? Wait, let's look and see what 14 or 15 is. That is consolidated information that I think is just comparing several different years with others. That is part of the management's discussion and analysis. That's supplementary information, okay? 33, okay. So yeah, okay, so there is this stockholders' equity on page 33. 30 is the balance sheet, okay. See, well, it's the balance sheet is on 30. So what are their total assets in 2008? $502 million. Okay, I looked this company up, and I meant to get them up on the screen, but their assets are now like triple that, I think. They've grown quite a lot. Now, tell me how this company had been doing lately. For instance, in 2008, did they make money? 2008, they made money? How much did they make? Yeah, look on page 31. That's the income statement. They lost $262,000. Okay, 2008 was not a good year for banks, and really several years in that time frame were not a good year for banks. Banks have been having a really hard time. Now, how much accumulated loss or income do they have? Where are we going to find that? Retained earnings. So what's their balance in retained earnings? Where do we find that? Where does retained earnings show up? Which statement? Balance sheet. Balance sheet. Okay. We do the income statement, then we plug that into retained earnings, and retained earnings shows up on the balance sheet, and their amount of retained earnings was $41 million and something. Okay. So they had been making money. That's what that tells you. They had been making money, but they have something funny called accumulated other comprehensive loss. Has anybody ever heard of that term before? Comprehensive loss. Well, that's something that we're going to study in chapter 4. when we study the income statement. And look on page 32. This is what you were looking at. Somebody just told me $335,000. That's their comprehensive income. That's, okay, so there's a net income. See at the top of page 32, it says net income, negative $262,000. And then we add in a lot of other things that are called other comprehensive income. Okay, those things we're going to study in chapter 4. What is other comprehensive income? Okay, so this is just kind of a way to look at this company. Now, how would a shareholder look at this company? What is the main thing that a shareholder would be interested in? Earnings per share. Where do we find that? Earnings per share.
Statement of owner's equity?
No. Where do we find earnings, period? Income statement. Do you see on the income statement? Are y'all on the income statement? Page 31. Yeah, the income statement doesn't say income statement at the top, does it? Yeah, so that's a little bit tricky. But on page 31 is the income statement. Our net income is negative $262,000. Do you see the earnings per share? What is that? How much did they earn per share?
We lost 3 cents.
3 cents. They lost 3 cents per share, okay? So what does that mean to me? So I have some bank stock. I have, let's see, how many shares did I buy of a bank? I think I bought, they were worth $10 each. So I spent $7,000. So I think I have 700 shares of bank stock, okay? And for that, I spent something like $10 each. Now, how happy would I be for my $10 each if we lost 3 cents? How good would that be? I wouldn't be happy, right? Okay. But what about if I made 28 cents and spent $10 per share? In other words, when would I, do you see how a shareholder would be kind of thinking, okay, what's my return on this stock? Assuming I spent this much money on it. I didn't buy any in this bank here, but assuming I spent so much per share on this stock and I made this amount, then a shareholder is going to be evaluating that to see if it was a good investment, right? Because what does a shareholder get when they buy stock? There's 2 things that they're hoping to get. One is dividends, right? I don't know, maybe these guys paid dividends. I don't see any. Oh yeah, cash dividend declared. Where would I find that? On the statement of owner's equity, right? On the statement of stockholders' equity, you see that they paid dividends of 24 cents a share. Well, I mean, depending on how much you paid for the stock, that might be a good amount, right? So they paid 24 cents a share. But then what's the other thing that a shareholder is looking for when they buy something? A what? Like how do they get a return on how do they ultimately, when they sell the stock, that it goes up, right? They want the value of the stock, like the market price of the stock, to increase so that when they sell it, they'll make money, right? Yeah. Okay, so the $7,000 that I spent on my stock, I must have bought at the top because I bought, sometime in the early 2000s or something. And I spent at very top of the market. A lot of banks were formed in Georgia around 2001, okay? And so I bought one of those new banks, paid $7,000, and the value of that bank went down to $700 in 4 years. So how about my return? Not so hot. I haven't sold it yet. It's kind of creeping up, but creeping. And no dividends. No dividends, and the value went down, right? So these are the things that stockholders are looking at. All right. So that's kind of a bad, sad story, isn't it? Yeah. Yeah. I only own two stocks, like stocks. There's mutual funds, but the two stocks that like I really own are bank stocks, and I bought them at the wrong time. No. No. They're still around. They're still kicking. I mean, a lot of banks went out of business in this period, but because they just, they just had a terrible time. I mean, I'm sure y'all remember about all of this.
91 banks in Georgia filed for bankruptcy.
Georgia had more banks go bankrupt than any other state. I mean, what's in the water, What's that, Silverton?
Silverton Bank, that's the bank.
Oh.
That's what they're tied to. All these community banks started created in 1998. They all started jumping on the bandwagon, and they were using Silverton Bank to get larger pieces of investments that were too large for their small bank. And then, as you see in Arizona, the $100 million, loan, whatever, defaulted and started collapsing.
Okay, well, I mean, it's that and it's other things. What they started doing was they started investing in or loaning money on property that was like beach property and stuff like that out of their comfort zone. And also there was a lot of building going on at that time, so they were overbuilding in their community. And like up near Atlanta, there's like subdivisions that are empty, full of houses that they lent money on, and they lost all of that. And then they bought participations, which I think is kind of like what you're talking about, where they bought bad loans from other banks to, spread the badness around. And so that just brought a lot of banks down, the several different factors. But they expanded beyond their banks used to be very conservative, and then all of a sudden in Georgia they went and got kind of aggressive. Okay, but this bank has, it wasn't doing terribly bad, but now it seems like it's really grown a lot and it's matured. And now you notice that all the stuff that we've been talking about is after page 30. Oh, let's look on page 29 and tell me what you see. What is that thing on page 29? Okay, so this is the auditor's report. So remember, we went over the auditor's report at the beginning of the class. Remember, it was in tiny print, or did we? Was that this class? No, that was my auditing class we did that in. Okay, every annual report has an auditor's report, and that's where the auditor went in and looked at this. And does it look like everything's fine with this company? What do they say? What's the auditor's opinion? Presented fairly. So does that sound like everything's fine?
So their job is to see whether it's presented fairly.
Right. Yeah, right. Okay, so good point. What is the auditor's job? Whose financial statements are these? Starting on page 30, whose financial statements are these? Who created the financial statements? Heritage Bank. Okay, Heritage Bank's management has said, these are our financial statements, and, they've stamped their approval on them, okay? Now the accounting firm goes in and they did a bunch of stuff. They conducted an audit and they did some tests and they looked at some evidence and they explained what they did in that second paragraph. Y'all read some of that, I'm sure, right? And so they did a bunch of stuff, and then their end result is they were presented fairly. They said the financial statements are presented fairly. So that gives kind of a stamp of approval. And public companies are required to be audited. I think, yeah. So now, what is going on in these first 28 pages? Let me just ask you this. The first 28 pages is that part of their financial statements. What we've said as part of their financial statements is balance sheet, income statement, statement of cash flows, statement of stockholders' equity, and note disclosures. So where does that stuff start? That stuff starts on like page 30, right? So what happens before then? What is all that stuff? The early stuff. It's on my PowerPoint, just as a clue. It's additional information, right? It's additional information. It's some stuff that the management themselves, management came up with all this additional information, and they said, y'all might be interested in some, like for instance, you might be interested in that you told us about where we analyzed, where we looked at 5 different years of stuff. Here's some stuff that might help you look at it. And then also, management's discussion and analysis is on page 16. And this is where management tells us about the company. What do they say about the company? This is the parent company of a holding group. And we were originally a credit union. Here's what our business is about. Here's what our market risk is. They compare the financial condition. Our total assets have increased 7%. Our total interest earnings have increased 5%. They're convincing you here about the status of the company and how the company is doing. What they say about net income. Oh, interest income increased. I don't see what they say about net income itself. They tell us about income tax expense. So they go line by line, more or less, on the financial statements and say, here's how we made this money and here's what our business is about, okay? Giving you deep information about the company. Now, is this part of the financial statements? It's additional information. So the financial statements are only those 4 statements and the note disclosures. See my point? And all this other stuff, they might have forecasts in there or something else. The auditor only audited, he tells you in his audit report, we audited the balance sheet, statement of operation, comprehensive income, stockholders' equity, and cash flows. That's what we looked at, and that's what we express an opinion on, okay? All right, so the reason I'm giving you this, I'm spending a lot of time on it on this day of class, is I think that it's very useful to see an actual set of financial statements. This is where we're trying to go in this class, is to be able to come up with an actual set of financial statements. And the idea is that when a user looks at these, we looked at several different things in here to see what might be going wrong, and to see, or if something is going wrong, okay? This particular company had accumulated other comprehensive loss. Remember that? Right here on the balance sheet, there was this other comprehensive loss, and there was an accumulated comprehensive loss. Now, I went back and looked. Now, they don't have an accumulated comprehensive loss, so all that's gone away. And really what that means is the comprehensive loss has to do with unrealized gains, which later on might mean something to you, right, in a couple of weeks. Unrealized gains, do you know what I mean by that? Unrealized, they haven't, like, what do I have on my stock that I spent $7,000 on and it's now worth $1,000 about now? So what do we call that? I spent $7,000 on it and it's now worth $1,000. Is that a gain or a loss? A loss. Is that a realized or an unrealized loss? Unrealized because I haven't sold it, okay? So this bank had a bunch of, as a matter of fact, they had $1.5 million in unrealized holding losses, right? And then that's going to do some damage right there, okay? So, all right, I think that's enough about these guys, and we'll continue on. And I'm going to get these back, so just like kind of put them out over on the edge there. So why do we have this information in the notes? Why do we have, remember, in the notes, what is the information there for? Do you remember the notes? Which one? So you're saying A? A, because we're giving additional disclosure under GAAP, right? We're just providing more information under GAAP. So remember, the notes were the things at the very, very back that were numbered, right? All right, so why do we have financial statement reporting? What is it good for? So that investors will have a way to decide what things they should invest in, okay? In other words, people like me that have money to invest, we have scarce resources, right? What do we mean by that? Money doesn't grow on trees. So if I'm going to invest $7,000, I want to be able to look at financial statements and have a trust in those financial statements to make a decision, right? So that's what this annual report is good for. It kind of gives you something to look at that you can trust. We know that it just wasn't put together quickly and sloppily. It was. We have some trust in it, but in a lot of countries, you don't trust the financial statements, really. So it's nice that here we have some trust in them, but you know what? There have been times when the financial statements haven't been so trustworthy, right? Have there been a couple of times? I don't know if y'all remember some of the financial accounting scandals, like Enron, WorldCom, different scandals where things. Now we've kind of turned that around, hopefully. So it's all of the above. It promotes productivity and innovation. And so when people invest in a company, that gives the company capital to work with. And there's really two ways a company can get capital. One is by issuing stock. By that I mean like money to expand their plant with, money to invest in their company. One is by issuing stock, another is bonds or something like that, borrowing money, okay? Getting a loan, okay? They can go down to the bank and get a loan, or they can issue bonds or something like that, okay? So to issue bonds or to go borrow money at a bank, you have to have somebody trust you. Somebody has to buy into your company and your company's vision and your company's financial statements and believe that you're going to pay the money back. People, when they invest their stock, I fully believed I was going to get dividends and the stock was going to go up, right? I didn't do it to lose $6,000, right? I did it because I somehow believed that things were going to be better. Anybody that loaned a company money thinks they're going to get their loan back, but that doesn't always happen, right? Okay. The objectives of financial reporting. Okay, so objectives of financial reporting. We want useful information. Our financial information needs to be useful to the equity investors and the lenders. We've talked about that. There's, really those two kind of users to the financial statements. And we want the information to be useful as they make decisions, okay? So the information needs to be useful for decision making. That's kind of the key. Useful for decision making, because these people are providing the capital. So now what we're wondering about is what makes information useful, right? What kind of information is more useful than other information? Now there's chapter 2 goes into a lot of detail about this, what makes So the financial statements need to be able to be useful to a wide variety of users. So like experienced users, people, we're going to go into there's more different users besides equity and creditors, but there's people that are interested in a lot of other things about the company. And we need to be able to provide this at where it doesn't cost a lot, not too expensive. I mean, all of this information, like the auditor, we had to pay the auditor a lot of money, and then to come up with a lot of these ratios and analysis and all of that, that's expensive. Information costs money to produce, and we don't want to give extra information that's not useful, okay? So, but the main thing that makes information useful is information about the cash flows. Because what am I concerned about? Like getting dividends back. And they can only pay me dividends back if they have the cash for it. And they can only pay back their loan if they have the cash for it. So that's really what you're interested in, is the cash. Now, let's kind of think about, though, are the financial statements on the cash basis? What's the basis of accounting that these financial statements are on? What do we call that? They're not on the cash basis, right? Because remember, last time when I had that thing, we have to make these adjusting entries when the cash is not in the same period as the expense. And why do we have to do that? Because the financial statements are on the accrual basis. In order to transfer, we transform our financial statements into the accrual basis, but investors are interested in cash inflows and outflows. So where can they find this information? Statement of cash flows, they can look there, or they might have to do something about depreciation, which is not a cash expense. Do you see what I mean? Depreciation's not a cash expense, right? But there it is on the income statement. So they might have to do some magic to get the statements into a form that they're going to be happy with, making a decision as to whether they can pay back the loan. Okay, that's really what they're interested in. Is management going to protect their capital? Are they going to blow it all, in frivolous things or paying themselves bonuses and stuff? Is there going to be something? Is the company going to grow and the stock value going to grow, or that's what they're looking at, cash flows. Okay, so in order for the information to be able to be useful for the people that are using the information, investors need to be able to look at the financial statements and be able to tell little details about how they were created. And they need to know that they were done according to some kind of criteria. And the criteria that's used is accounting standards or generally accepted accounting principles, okay? GAAP. Are y'all familiar with that term, GAAP? Generally accepted accounting principles. Okay, so that is a set of standards that financial statements are created by and that have a bunch of rules. Now, let me give you an example on page 7. On page 7, there's some information about GAAP. And it says right here on the slide, the accounting profession has a set of standards that are generally accepted, okay? But on page 7, it goes into a little more detail. And what does it tell us in addition to that? In addition to the fact that we can get GAAP from standards, we can also get GAAP from what? Well, no, that's not what I'm referring to. It's on the middle of page 7 where it defines GAAP, a set of standards. It means GAAP or generally accepted means that either we have a rulemaking body, which may be what you were talking about, has established the principles, or everyone accepts it, a practice over time, okay? So it could be that we either going to get our standards from this rulemaking body, or it's going to be from a practice over time, okay? Now, the thing is, the reason I bring this up, this is just like one small example of tiny little words in the book that are really important in this class. You know, that there's, not everything's going to be on the slide. Some people are used to taking a test off of PowerPoints, and that won't really work. You know, you're going to have to dig deeper than the PowerPoint, so you need to really dig into the book, okay? So the PowerPoints are going to kind of be an overview or an outline, and the book is going to provide a lot more detail. And so this might be just a good time to say that, and I think I might have already said this, read the book at least twice. Once before class, once maybe after class, and once right before the test. That's 3 times, but at least twice, okay? The third time, could be just you read your highlighted parts. So as you read through here, I would highlight and or outline the chapter, okay? So who is responsible for kind of giving us the accounting standards? That's our question here. So there's 3 organizations that are important in standard setting. The SEC is the first one. You'll notice that there's a lot of initials here. So like, could you identify who the SEC is with just the initials, right? You're familiar with these guys? Securities and Exchange Commission, okay. And the AICPA, familiar with those guys? Maybe not as much, right? Okay, and the FASB, okay? So these initials you need to be familiar with. And there's also a bunch of other initials listed kind of in the back of the chapter. And I wanted to point out that on page 27, there are a list of initials, the ones that we've gone over in this chapter, that might be, it's number 12, CA12, and it gives you the acronyms. That might be a good review to look at those. Okay, so we're going to talk first about the SEC. When did the SEC come into being, and why did the SEC come into being? After the Depression, because a lot of people lost money on their investments. And, okay, let me just say, I've lost $6,000 on that one investment and about the same on another investment, but I will not be jumping out of a tall building, okay? That's not as big a deal to me, but during the Great Depression, people jumped out of tall buildings, right? When they lost money, when the stock market crashed. Even if I lost everything in the stock market, I'm not jumping out of a building, just to let y'all know, okay? But that's what happened. It was so prevalent. All the stocks went to pot. Okay, fine, my bank stocks went to pot. As a matter of fact, I had stocks, you know, and when we had all this financial crisis, the value of my other stocks that were in a mutual fund, they were cut in half, slashed in half. It was a lot of money, way more than that $12,000. But it was slashed in half, but it's come back. You know, now it's worth more than it was back then. And so things go up, things go down. I'm not jumping out of a tall building, okay? But it was so bad in the Depression. I mean, times were super bad. And so the SEC was established. Congress mandated, the federal government established it, Congress mandated it. There were these 2 Securities Acts. And who does the SEC control? What type of companies does the SEC prescribe standards for? Public companies. Public companies have to adhere to the SEC's version of GAAP. The SEC has oversight over these companies. If these companies commit accounting fraud, they can enforce things like, if a company does their accounting wrong, the SEC can stop the sale of that stock on the stock exchanges. That's the kind of power that they have, okay? So they can issue a cease and desist order. That doesn't happen that much. Okay, the AICPA, look, it used to be that the AICPA said, no, the SEC entrusted the AICPA with like being the accounting standard setter. Okay, you'll see these two boxes. We had the Committee on Accounting Procedures for like 20 years, from 1939 to 1959, and then we had the Accounting Principles Board from 59 to 73, and these were the two organizations that the SEC entrusted with actually setting the standards. The SEC has kind of a broad oversight of the standards, and like companies file their financial statements with the SEC, and so the SEC is like, they can punish companies, they oversee accounting standards, and if they feel like there needs to be an accounting standard in a certain area, they can push for, come on, develop us a standard about this. So they're kind of the big daddy in charge, but the ones that were developing the standards for a good long time was the AICPA. So what does AICPA sound like? It's a bunch of CPAs, right? It's a bunch of CPAs that made up the accounting rules, okay? And they were in charge of the standards. Are they in charge of the standards now? No, somehow they got pulled from that duty, and now the FASB is in charge of the standards. Okay, so the FASB is a small board that has kind of oversight and actual ability to implement accounting standards. Okay, and there's really kind of like three parts of this. See, the FASB is the one in the middle, the white box, Financial Accounting Standards Board. They have a boss, the Financial Accounting Foundation, that selects the members of the FASB. Okay. So what is the FASB? They have a small membership. They are paid full-time to do this. This is their job full-time, the people on this board. And there's a broad representation, meaning that they're not a bunch of accountants. That's what that means. It's not just a bunch of accountants. There's kind of like people that would be interested from like an investor point of view or a lender point of view, that kind of thing. Okay. This question's kind of out of place, but how does the FASB go about setting an accounting standard? And this is the system that they use. Most recently, the FASB changed the rules for revenue recognition. Revenue recognition. So a lot of times the FASB, they might make up rules for leases or for tiny little things to do with a small section of the economy. But when they are going to change the rules for revenue recognition, what does that mean? That's when you can book revenue, like when you can put revenue in your financial statements. How important is that rule? Very important, because what's more important than revenue, right? I mean, that's like the key to the income statement, the revenue part. And if a company is going to mess with their books or inflate their earnings or make themselves look better than they really are, if they're going to going to make their financial statements look good, it's usually through revenue. So this was very important. Okay, so this is the kind of thing, they might think, oh, something's wrong with the revenue rules. We need to do something about it, okay? So what do? We identify the topic and put it on the board's agenda. Then we do some research about it. This thing's been going back and forth, and people have been writing letters and all kind of stuff about it. They have a public hearing, then they evaluate evidence from the public. It's this long process that might take years, okay? Then they finally vote on it. There's something called an exposure draft where it's all public as to what they're doing, and this is how they're thinking about changing the rules. And then they issue a standard, an accounting standard. And the accounting standards are, they're written on very thin sheets of paper, kind of like this, and they're very hard to read. And it goes out to everybody. And then all the accounting firms have to figure out what to do with it. And then all the, Procter & Gamble has to figure out what to do with the new revenue recognition standard. So it's a big process to do that kind of thing.
What did they change to recognition?
I have not looked at it. But I know that this book has, revenue recognition. I hadn't looked at it because it's in the later, like intermediate 2 or 3, but this book has like a supplement because of that. So now the textbooks all have to change. This just happened a week ago.
Really?
Yeah.
That sucks.
Yeah.
We just bought the book.
Yeah. No, it changes all the time. This book's going to, in the next 2 years, a lot of different things are going to change. A lot of different accounting rules, they change all the time. And that's the thing about accounting rules is it's a continuous process. Okay. So here's the sources of GAAP. I'm not really going to go on, a lot about this. I'm not going to spend as much time on this part of the PowerPoint. But I am going to mention that it used to be that the GAAP was in a lot of different, as you could see there that I just skipped through, a bunch of different sources of GAAP that went over a long period of time. Remember, this started in like 1939, all these different things. And you would have the rules of accounting in these books that were like up on shelves. And then they would issue a new standard and they'd say, take out page 20 through 50 in this book over here and replace it with these pages right here. They'd send the accounting firms loose leaf sheets of paper to go change all their rules. So see, it got pretty complicated. So what they would call that is this section was superseded by this other section. And so since it had changed so much, it was very complicated. The law is a lot like that. I don't know if you've seen a law library with all those law books. Well, the same things like that in an accounting firm. They had these libraries with all these books. But now what they've done is they've got a codification process. And that's where they've put all the changes to the rules and all the rules, they've organized them into one type of GAAP, which gives you all the detail of, for instance, right here, this is about receivables. And see how it, like section 310 is receivables. And then you go all the way down the tree to trouble debt, restructuring, initial measurements. And then finally, here's the section that's for loans and trade receivables not held for sale. And then right here is where you could find any kind of rule for this area. So you kind of go down this tree structure to find it. That way, that's all online. All this codification is online. And if you're doing research into how to treat a certain thing, you can go to the codification and find all the details in one place rather than having to go to your books in the library and stuff. Okay, so the different user groups, who is interested in financial statements? I said it was just more than the investors and creditors. Also, for instance, the SEC, the IRS, and other agencies have some kind of interest. But this doesn't really say. People that work at the company do, because they want to make sure that their pension plan is good. I know a lot of people work at Procter & Gamble in Albany. They get stock as far as bonuses. A lot of their bonuses are in stock. And a lot of people have hundreds of thousands of dollars worth of Procter & Gamble stock. How interested are they in how Procter & Gamble does? You know, they're going to be very interested in the financial statements. So there's a lot of these people might have, people that do business with a company, like buy things or sell things to a company, are interested. So a lot of these interested parties have like conflicting opinions. So like one person might want things to be stricter and the next one might want things to be looser. So it's kind of a political process coming up with the accounting rules. Now the expectation gap is, what are people's expectations on reading page 29 in here, where the accounting firm said it presents fairly? What do you think investors think about that it presents fairly? So they want to trust that, right? Is that a stamp of approval? Everything's fine, right? But the fact of the matter is, you know, the accounting firm just went and did some tests and looked at evidence, and maybe they hadn't turned over every single rock and looked in every single closet, you know. So the public's idea is, okay, great, all is well. But occasionally companies have gone bankrupt within a year of the CPA firm saying everything's fine. Do you see how that would be upsetting to an investor? Wait a minute. I thought you said everything was fine, you know? So the expectation of the public is pretty high compared to maybe what CPA firms are actually delivering. So, and a lot of it is because these accounting scandals, a lot of time management manipulated the financial statements like they manipulated the statements. They got together amongst themselves and decided we're going to inflate earnings, okay? So it's hard to find that sort of thing. You know, it's a crime to do that, and it's hard to find that sort of thing. So there is this gap in what accounting firms are delivering, is the point. So these are, I think this might be the last main thing that we're going to talk about, but things that might be coming in the future. It says right there are challenges, but these are things that might change in the future, okay? So what do we mean by non-financial measurements? There's some things about companies that are important that don't have to do with, that you can't measure, that aren't actual cash. So what are we talking about in that way? Certain companies have like a great idea or a super product or something that is like worth something over and above, you know, a financial thing that you really can't measure financially. Maybe, well, maybe not patent-wise even, but just, and it's kind of an asset. I mean, you know some companies that like have this, okay, the swoosh, Nike swoosh. Okay, well that's a trademark, and so maybe they paid money to get the trademark and all like that. But that's just like this thing that's not really included in the financial statement, the fact that there's all this buzz generated by just certain things that you can't really measure. You can't really measure really what that's worth, you know, and it's not on the financial statements. Okay, forward-looking information. The financial statements tell us what happened last year. Okay, so right now, what is the latest annual report we have for any company, you know, that had 12/31 year in, it's 12/31/2013. So if I'm trying to invest, I mean, it's 8 months old already. So wouldn't it be nice if they would give us, here's how we think we're going to do in the future, right? But yet, why is that not good? Because we can't really tie down. That's just smoke and mirrors, right? So it's, do you see what I mean? You're not able to quantify, here's how we think we're going to do in the future. But it might be nice. Investors really know, they want to know about the future. They want to know about future cash flows, not past cash flows. They want to be able to think, what money might I be able to make from this company in the future? Timeliness, information is already old by the time it's released. It's, over a month old by the time financial statements are out there. So maybe more timely information would be good. And understandability. So when y'all were looking through here, how understandable was this? And you guys have had 2 accounting classes, right? Do you see what I mean? It's not crystal clear to people. And a lot of this is, you really have to be a sophisticated investor, seemingly, to understand this. But what the financial statements are designed for is someone who has a good business knowledge. Okay? It's not, maybe everybody at Walmart can understand them, right? But somebody with a good business background, they're targeted toward those people, okay? International standards. Have we talked about international standards? Okay. GAAP is a US-based thing. And we have the FASB for GAAP. The IASB, those are the international accounting standards, and supposedly the 2 were going to merge as early as a few years ago, and currently, supposedly by next year, which is not happening, but they're not getting along so well. These guys that are supposed to be merging, the IASB and the FASB, are not getting along so well, and I don't think they're going to be merging by next year, okay? So hundreds of other countries, use IASB rules. The United States uses US GAAP, FASB rules, okay? So a lot of the European countries, basically all of the developed world, basically all of Europe and the developed world uses IASB. Okay. Now, parts of this IASB rules are on the CPA exam too. They're starting to be on the CPA exam. Leases, for instance. The United States has operating leases and leases that are more of an asset, a capital lease. And just recently, the IASB they changed it to where there's only one kind of lease. So that sounds like not that big a deal, but think of all the companies that lease trucks. I mean, companies lease a lot of stuff. And a lot of their balance sheet will change if leases have to be put on the balance sheet. That's a capital lease. Operating leases are the expense that you pay for a lease goes on the income statement. So that's a big deal. Are you going to put it on the balance sheet or the income statement? It's going to affect net income dramatically. And IASB just changed that, and they were supposed to get together, the US and the IASB were supposed to get together and have a joint lease thing, but I think that IASB just went off on their own and changed it, and the US was left watching. So it's a big deal, but think about a company like Coca-Cola or whoever. A lot of companies have international operations. So they have to know international rules as well as US rules and issue 2 different kind of statements, basically. Okay, ethics. We're not going to talk about today, although it's one of my favorite topics. We'll just leave that for later. Okay, so next time we come, this is Labor Day, so we don't come, right? Labor Day weekend, we don't come Monday. Wednesday when you come, you should read chapter 2 and remember to do the homework that's out there. And remember to give me back those books.